Picture a family of 4 sitting down to plan their groceries for the month. Nothing extravagant, just the basics. Chicken, pasta, eggs, milk, bread, maybe some frozen vegetables to stretch the budget a little further. According to the United States Department of Agriculture, feeding that family on the absolute tightest budget possible cost $654 a month in January 2020. By January 2024, that exact same basket of food cost $976 a month. That is an extra $322 every single month, nearly $3,900 vanishing from that family's budget every year, just to eat at the same level they were eating 4 years before. Most people hear the word inflation and picture an economic abstraction, something that lives in a spreadsheet at the Federal Reserve. But this number does not live in a spreadsheet. It lives in the moment you look at your grocery receipt, do the mental math, and feel something shift in your chest. The prices climbed, the portions shrank, and the companies responsible had a very specific explanation ready for you. The question this video is going to answer is a simple one. How much of what happened to your grocery bill was genuinely unavoidable, and how much of it was a choice that someone else made for you? Before this video makes its central argument, it needs to make a different one first, because fairness matters, and the story of grocery prices is not a simple story of corporate villains operating in a frictionless world. The cost pressures that food companies faced between 2020 and 2023 were genuinely severe, and dismissing them entirely would be both dishonest and wrong. By the end of 2022, more than 43 million egg-laying hens had been lost to avian influenza or emergency depopulation since the outbreak began in February of that year. Egg inventories fell 29% below their January levels by December. Rebuilding a laying flock takes the better part of a year because biology does not move on a corporate timeline. That supply shock was real, and it was severe. Then came the war in Ukraine, which the global food system was not remotely prepared for. Russia and Ukraine together accounted for 28% of global wheat exports and 75% of global sunflower oil exports in the year before the invasion. Wheat prices spiked 58% higher in March 2022 compared to a year earlier. Bread, pasta, cooking oil, cereal, and virtually every baked product on a grocery shelf felt that shock ripple through their production costs within months. Add pandemic-driven labor shortages that compressed output across meat processing plants and rising fuel costs that made every mile of transportation more expensive, and you have a genuine, documented, multi-layered cost crisis landing simultaneously on an industry with tight operating margins. This video does not dispute any of that. What it disputes is the next part. The part where those costs were used to justify something considerably larger than the costs themselves. There is a simple test that anyone can apply to figure out whether a price increase is cost-driven or profit-driven, and it does not require an economics degree. Imagine you run a small business and your rent goes up by $200 a month. So you raise your prices by $200 to compensate. Your profit at the end of the month is exactly what it was before. The cost was passed along, your margin stayed flat, and nobody could reasonably accuse you of taking advantage of anyone. Now imagine your rent goes up by the same $200, but you raise your prices by $350, and when your customers ask why everything costs more, you tell them it was because of the rent. You have made an extra $150 and offered a story that is technically true, but substantially incomplete. The rent did go up. You just used it to do something more than cover the rent. This is the test that the Federal Trade Commission applied to the grocery sector, and in March 2024, it published what it found. Food and beverage retailer revenues increased to more than 6% over total costs in 2021, higher than their most recent peak of 5.6% in 2015. In the first 3 quarters of 2023, retailer profits rose even further, with revenue reaching 7% over total costs. The FTC's calculation controlled for labor costs, fixed costs, and every other legitimate expense. The agency concluded that some firms appear to have used rising costs as an opportunity to further hike prices to increase their profits, with those profits remaining elevated even as supply chain pressures eased. In their own words, and this profit trend casts doubt on assertions that rising prices at the grocery store are simply moving in lockstep with retailers' own rising costs. The cost increase was real. The price increase was larger. Here is what the same period looked like from two completely different vantage points. From the checkout line, you saw eggs nearly double in price, ground beef up more than a third, and milk costing noticeably more every time you reached for it. In March 2024, consumers were paying 95% more for a carton of eggs, 33% more for a pound of ground beef, and 22% more for a gallon of milk than they had paid before the pandemic. The companies responsible for those products had a consistent explanation ready: supply chain disruptions, avian flu, higher input costs, the war in Ukraine. These were, as the previous section established, real factors that genuinely drove costs upward. From the earnings call, the same period looked entirely different. See, Cal-Maine Foods, which controls roughly 20% of the nation's egg market, brought in over $320 million in net income for the single quarter ending in late February 2023, a 718% increase compared to the same quarter the prior year. Their CEO described the results as reflective of a dynamic market environment with higher average selling prices. Meanwhile, Kraft Heinz reported that its net income increased 447.9% in the fourth quarter of 2022, with the company's CEO calling it an incredible year. These two sets of numbers describe the same supply shock, the same avian flu outbreak, the same Ukraine war, the same labor shortages. The costs that executives cited publicly to justify price increases are the same costs that appear in the filings where they reported those record profits. Only if the supply chain explanation fully accounted for the price increases, then the profits should have stayed roughly flat. They did not come close to staying flat. That gap between the story told to consumers and the numbers reported to investors is precisely what this video is about. There is a second mechanism at work in your grocery bill, one that is harder to see than a price tag change precisely because it is designed to be that way. You open a new box of cereal and something feels slightly off. The bag inside the box seems less full than you remember. Your bag of chips runs out 2 days earlier than it used to. Your coffee can needs replacing a week sooner. You assume you are just using more or misremembering, or that things always felt this way. You are probably not misremembering. About 1/3 of roughly 100 common consumer products tracked by LendingTree have shrunk in size or quantity since the pandemic, based on a comparison of Walmart prices and product sizes from 2019 and 2020 against 2024 data. The term for this is shrinkflation. The price on the tag stays flat or moves modestly, but the amount inside the package quietly decreases. The effect on your wallet is identical to a price increase, and in some categories, the math is striking. Family-sized Frosted Flakes shrank from 24 ounces to 21.7 ounces, and that reduction translated into a 40% increase in the per-ounce price consumers were paying. Campbell's Homestyle soup cans lost 2.5 ounces at the same shelf price. Huggies Little Snugglers dropped from 96 diapers per package to 84, while the price held at $29.99. What makes this form of price increase particularly significant is where it shows up, or rather, where it does not. The Government Accountability Office confirmed that shrinkflation had a minimal impact on overall consumer price inflation figures because downsized products made up a small percentage of goods and services tracked in standard inflation measures. The headline number that economists and journalists cite does not fully capture what happened to your per-unit cost. You paid more per ounce, per diaper, per sheet of paper towel, but the official inflation figure said the price was essentially stable. The checkout receipt told the truth. The official statistics told a different story. 9 in 10 American adults say they are concerned about the cost of groceries. That number is striking precisely because it cuts across income levels, age groups, and political affiliations in a way that almost no other issue does. But concern is not the same as consequence, and the consequences of what has happened to food prices over the last several years are distributed in a way that is neither random nor equal. According to USDA data from 2023, households in the lowest income quintile, those earning roughly $16,000 a year after taxes, spent 32.6% of their total income on food. Households in the highest income quintile, earning over $211,000 a year, spent just 8.1%. That is a 4-to-1 gap in how much of a household's resources food consumes before any price increase occurs. When food prices rise by 25% across the board, those two households do not experience the same event. One absorbs an inconvenience and perhaps cuts back on dining out. The other absorbs the equivalent of losing a month of income every year and faces a genuine choice between food and something else: rent, medicine, a bill that was already overdue. In 2024, nearly 1 in 7 American households, roughly 18.3 million, reported being food insecure at some point during the year, meaning they could not reliably afford enough food for all their members. These are not households that switched to store-brand cereal and moved on. These are households for which the margin of error in a grocery budget had already been spent before the price of ground beef moved another 30%. The point is not that wealthy households were unaffected by food price increases. The point is that for one group, it was a financial annoyance. For the other, it was a reduction in what they could eat. The gap between the public explanation and the private reality does not require interpretation. It is documented in public filings that anyone with an internet connection can read today, because companies that trade on stock exchanges are legally required to tell their investors the truth, even when what they tell the public is considerably more vague. Start with the Tyson Foods Q1 2022 earnings call. A Wall Street analyst asked the CEO, Donnie King, about whether consumers were pushing back against price increases. King told investors that price elasticities in their prepared foods division were less or lower than what they have historically been, which is exciting there, adding that the company had been able to maintain volume in this inflationary environment. Exciting. The word is important. To the public, so Tyson was citing supply chain costs. To investors, the CEO was describing the discovery that customers had no real alternative and framing it as a business opportunity. Then there is General Mills. Across multiple consecutive SEC filings covering fiscal 2022 and 2023, the primary driver of adjusted operating profit growth is listed as favorable net price realization and mix, consistently placed above higher input costs in the attribution of results. Favorable net price realization is the accounting term for charging more than your costs required. It is not the language General Mills used in press releases about supply chains. And then there is Utz, the snack food company. On their Q1 2022 earnings call, the CEO was asked directly about the breakdown of their price increases, and he confirmed that price pack architecture, the industry's internal term for shrinkflation, accounted for roughly 20% of their total price inflation that quarter. 3 companies, 3 sets of public documents, 3 executives describing, in detail, strategies that went considerably beyond passing costs along to consumers, all while their press releases and public statements attributed every price increase to forces entirely outside their control. There is one final piece of evidence that closes this argument more cleanly than anything else in this video. If the official story were entirely true, that food price increases were driven exclusively by input costs, then when those input costs came back down, grocery prices should have followed them down. That is how a straightforward cost pass-through relationship works. The costs go up, the prices go up. The costs come down, the prices come down. The costs came down. Farm-level wheat prices fell 23% in 2023, then another 22% in 2024, and a further 11% in 2025 from their 2022 peak, a cumulative collapse of well over half their wartime high. Global commodity prices overall dropped roughly 30% from their June 2022 peak by early 2023. But shipping costs that had surged during the pandemic returned to near pre-pandemic levels. Energy prices moderated significantly from 2022 highs. And yet, food-at-home prices in 2023 still increased 5.0%, and in 2024 rose another 1.2%, continuing to build on the already elevated base from prior years rather than retreating toward it. Industry analysts have confirmed that food and beverage prices are unlikely to return to pre-pandemic levels at all. Between 2021 and 2022, the food and beverage industry recorded more than $155 billion in profits. Those margins did not compress when commodity costs fell. They became the new baseline. The prices set during the cost crisis were treated as a temporary ceiling on the way up and a permanent floor on the way down. That asymmetry, costs falling, your prices staying high, is not a supply chain story. It is a power story. So here is the answer to the question this video opened with. How much of what happened to your grocery bill was genuinely unavoidable? Some of it. The avian flu was real. The Ukraine war was real. The supply chain disruptions were real, and they caused cost increases that no company could simply absorb without consequence. How much was a choice? The margin expansion above those costs was a choice. The shrinkflation was a choice. The record profits paid out as dividends while publicly citing supply chain hardship, that was a choice. The ratchet that held prices elevated after input costs fell by more than half, that was a choice. Each of those choices was made by a specific person in a specific boardroom, and each one is documented in a specific SEC filing that you can read yourself today. This video is not calling any of that evil, and it is calling it what it is. A rational response to the discovery that when you control most of the market and consumers have nowhere else to go, a crisis is not just a problem, it is also an opportunity. The food industry learned from this disruption. It learned exactly how much it can extract before people stop buying. The next supply shock, drought, disease, conflict, whatever form it takes, will be navigated by companies that now have that knowledge and an even more consolidated market to operate in. If you want to understand what that means for your grocery bill, subscribe, because that is the next video.